Hi guys, welcome to the channel. My name's Tim, and on today's episode, we're going to do a thought experiment. So this here is 1929, the peak. And down here was an 89% crash. Now let's say you're a 30-year-old. All your friends are making money in the stock market in the roaring 20s. You decide to put your life savings in, let's say 20 grand. All of a sudden, the market crashes. You can't sell, so you decide to HODL. You figure the market will bounce back. You wait. You end up waiting 25 years to about 1954 when you actually have broken even. By this stage, you're about 55 years old and you've just broken even. You then have about 11 years of a bull market to earn some money. By this stage, you're about 66 years old. The market then goes sideways for about 17 years and you're 83, pretty much the end of a lifetime. And you've only had 10 or 11 years of actually being involved in a bull market, making money. Let's say you're 40 years old and do the same thing. You wait 25 years, you're 65 years old. You then have 11 years of a bull market. You're 75 years old by this stage. And then the market goes sideways for 17 years and you probably don't even make it to this point. So this is pretty dire. But the point I'm making here is that sometimes HODLing is not the best method. And simply just throwing money into the stock market and not caring doesn't always work. Now, if I just bring up this, we can see some of the greatest investors that have ever lived. And you notice they're all born around this period of time, around the 1930s. Look, Warren Buffett was born in 1930. Charlie Munger was born in 1924. George Soros, 1930. John C. Bogle was born at the peak of 1929. So all these investors, the greatest investors of all time, didn't really have to worry about this Great Depression. By the time they were around 18 or 20 years old, when they would start investing, it was around here, around 1950. If we zoom out, look at this. What a run. If you were born around 1930, you had absolutely the best run possible. A stock market that either went up or sideways for the most part of 70 years. And if we look at Warren Buffett's net worth, you can see, starting with $5,000 or $6,000, it just worked its way up to these incredible levels of about $60 billion. So these investors were born at such a perfect time to make the most of the US stock market. But it begs the question, what about people that were born over here? People had to invest during the Great Depression, having to wait 25 years if you decided to HODL. That's a big portion of your investment lifetime and doesn't leave a lot of opportunity to actually make any money. So, looking forward, what happens if we have another catastrophic market crash like in 1929? How do we navigate that? For the people born in this era, if you're 30 or 40 years old, What should you do with your money? Do we just blindly put money into the stock market and HODL it? If we do that, could we be waiting potentially 25 years after a crash? And you have to ask yourself how old you will be at that point in time. So these are some really philosophical and big, scary questions to ask. You might be wondering, well, why would there be a crash? Where's the proof? So I'll just draw your attention to a couple of things. This here is the last couple hundred years of the stock markets. And it's coming from this book called Conquer the Crash from Robert Precher. But you can see here, this is the 1929 crash that we've just been looking at. But you go back roughly 100 years, around 1840, and there was another reset, another massive crash. And you can tell by this sort of ABC shape. This is around the railway mania that was occurring in Britain. And then you go back another 100 years, roughly, to 1720. And this was the South Sea bubble. So you can see every 100 years or so, there is a great reset, some sort of deleveraging, some sort of massive market crash. Ray Dalio also talks about the long-term debt cycle, which lasts 75 to 100 years, involving credit and that credit having to be paid back. Now we are currently 90 years, or over 90 years from 1929. So we are kind of moving into that territory. And again, we look at elements like the money supply, which has increased exponentially. We look at the debt, which has increased exponentially. And we look at other economists. I'd just like to draw your attention here to another Australian economist, and I've actually ordered the book from this economist. His name's Philip J. Anderson, and I just recommend you check out his website, check out his YouTube channel, check out his work. He talks about the real estate cycle and how the markets follow the real estate cycle. And in a nutshell here, it's basically 14 years up and 4 years down. And he's gone through centuries worth of data looking at this 18.6 year cycle. And it's basically also predicting a potential crash around the 2026 mark. So we had the last real estate cycle, crashing around 2009 with the great financial crisis. It would last about 4 years to about 2013. Then we have 7 years up to about 2020. We have some sort of mid-cycle slowdown. And then you have another 7 years up on average, which brings us somewhere in that 2026, 2027 mark. And that's typically when there would be a real estate crash. Now, added to that, we're coming to the end of a super cycle. This textbook Elliott wave, this 1, 2, 3, 4, 5 wave. And if you look at Elliott wave, typically the fifth wave, 1, 2, 3, 4, 5, it gets blown apart by this crash and you lose all of the gains with this ABC correction. Now, if that were to occur, it means it would put us back somewhere around the 2009 Great Financial Crisis numbers, which would be catastrophic. So using Philip's cycle prediction around this sort of 2026 mark, and the fact that we're coming to this end of a super cycle, this Elliott wave theory, and you can see here the first wave was 24 years, the second wave, which is the largest, was 26 years. The last wave is usually the shortest. So if we go to 2026, it's about 17 years. If we go a bit further, say to 30, it's about 21 years. So somewhere in this range. We can see that we're getting further away from the 25-year moving average. Now, we did bounce off the average here and here, but in 1929, we got so far away from it that we crashed through it, and that was the devastating crash. If we were to crash through the 25-year moving average, it'll put us back to the levels of the Great Financial Crisis. To add further weight to this argument, typically at the end of a real estate cycle, you have world's greatest or tallest buildings being built. And if you look through here, you can see we've got a bunch, and these aren't the tallest in the world, but they are certainly some tall buildings. And the tallest building, the Jeddah Tower, doesn't have a completion date yet, but no doubt they started construction in 2013, right at the start of the real estate cycle, and you'd imagine by the end of the cycle, somewhere around 2026, or if there's delays, maybe towards the end of the decade, this building will be built, and that will probably mark the start of a crash. So, it sounds very dire. However, the silver lining is we can learn from history. And while Warren Buffett, Charlie Munger, and everyone in this region here has provided us with a wealth of advice around value investing and how to make money on the stock market, what I think we need to do instead is go back a bit further in time and learn from these people. The people that had to work through the Great Depression, and just learn what they did. And just remember that where there is great volatility, there is great opportunity. So if you are able to buy a dip like this, even when the world is struggling, this would be the absolute most amazing opportunity of a lifetime. And also leading up to one of these peaks where there's potentially mania and euphoria. If you are able to invest smartly and have an exit strategy, knowing that when the market is getting overextended, looking at these types of measurements, looking at the sentiment around society, selling as you go, not HODLing and keeping all your money and all your eggs in the one basket. You have an opportunity to save capital and then reinvest down here. So there are ways to navigate great volatility in the markets like this. And we need to learn more from these investors, the ones that were born leading up to this Great Depression. Of course, this may not happen, but it's something we need to keep an eye on. There is already speculative markets. There's already inflation. There's already money printing. We're already moving further away from the moving averages. We are due for a 100-year reset. The debt levels are the largest in history. There are many factors pointing to this. We've got the real estate cycle also. So that's all I wanted to say. And if there was one message from this video, it is to not be complacent, and also learn from history, and not just learn from the last 10 years of history, not just learn from the last 100 years of history, but try to learn from the last 150 to 300 years of history. And that can give us some advice and give us some wisdom of what we can do in the future. So I hope you enjoyed that video. It's quite late, talking very quietly and somberly. But I hope you enjoyed that. This is not financial advice. It is purely entertainment, but I'm hoping it can stimulate some thinking. And if you've got any ideas or thoughts in this space, please comment below. I'd love to join in the discussion. So until next time, I'm Tim, and cheers.